Good afternoon. Welcome to SIAS Eagle Hospitality Real Estate Investment Trust dialogue session. Over the last 1 year, SIAS has been in active communications with EHT's trustee, the stapled security holders, and even formed an informal steering committee comprising about 8 large unit holders to petition for the appointment of an official equity committee in EHT's U.S. bankruptcy proceedings under Chapter 11 of the United States Bankruptcy Code, so as to ensure that EHT unit holders have a voice in EHT's bankruptcy. As you would know, in early 2021, EHT and its subsidiaries filed for bankruptcy in the United States under Chapter 11 of the United States Bankruptcy Code. There have been a number of investor queries and recent media reports that have raised some common issues. Therefore, at this dialogue session, SIAS hopes to get more clarity on the issues. Before we start, I would like to introduce the speaker and panelists for today. Mr. Bert Grisel, Managing Director from Moelis Company, Ms. Jane Lim, Head of Corporate from DBS Trustee Limited, and Mr. Danny Ong, Partner from Rajah Tann Singapore. I shall now hand over to Mr. Bert Grisel from Moelis Company, as well as Ms. Jane Lim, Head Corporate, to the presentation. Bert and Jane, please.
Just to recap the year of 2020, the master lessee's various delinquencies exacerbated by the effects of COVID-19 have led to almost complete lack of rental income and rapidly accumulating property level liabilities. As a result, EHT defaulted on its US $341 million syndicated loan and breached several other operating contracts. As a key step to safeguard, value, and protect the interests of staple security holders, aside from continued management of stakeholders and properties, the trustee and the company were involved in forming a special committee to manage possible conflicts of interest between the sponsor and the master lessees. The special committee and the trustee initiated the previous RFP process, but being unable to proceed with it as the owners of the sponsor had entered into exclusive discussions with Far East Consortium, who did not proceed with the proposed transaction at the end of the day. Subsequently, the MLAs were terminated and the RFP process was relaunched. Multiple possible REIT managers and capital providers were invited to provide proposals. As a result of the RFP process, SC Capital was selected as the party to have put forth the most credible proposal for a replacement manager and a recapitalization, and the only one proposal that was acceptable to the lenders. The SC Capital proposals was put forward to the staple security holders for voting at the EGM held on 30th December 2020. Despite the trustees and its advisors' active engagement with staple security holders and several discussions with large unit holders, in the weeks leading up to the EGM and the strong participation of voting staple security holders, where 73.2% had voted at the EGM, the necessary resolutions for the SC Capital proposal to recapitalize EH-REIT and appointment of a new manager were not carried. In addition, the REIT manager was removed under MES's direction on the same date. As a result of the voting and the lack of replacement manager, EH-REIT had no liquidity left to continue as a going concern, and hence Chapter 11 was the only option available.
Thank you, Jane. If we can turn to page 4, slide 4, please. As you have heard from Jane, sort of the lead up to effectively the EGM and where we sort of found ourselves, I'd like to remind everybody that the circular for the EGM contained very clear language about the consequences of the EGM not carrying the resolutions and the sort of subsequent risks involved. In order to manage that, let's say, risk transparently, we had organized focus group sessions, including a session with SIAS, We had many public announcements in order to transparently inform the market of the issue at stake. If I can take you to the next slide, and as Jane said, it didn't leave us with any option but to file been clearly indicated in the circular. As we all know, the resolutions were not carried and EHT was compelled to seek insolvency protection under Chapter 11. And the reasons for that are there was simply no liquidity left to continue as a going concern, and we had to find liquidity. The only way to do that was effectively through a Chapter 11, so that we would have liquidity to pay for ongoing maintenance costs and sort of continue as an operating concern. Another important argument was that we had to protect ourselves from the risk of foreclosure during the period where we were working together with the banks to find a solution, and the solution proposed also to the EGM was effectively done under forbearance agreements, and we were quite mindful that forbearance agreements might not be extended, and hence we needed the global stay from a Chapter 11. So it was necessary to commence a Chapter 11 process for 15 of the 18 properties, and one Chapter 11 is a tried and tested method in the US, and all assets and almost all operating contracts are in the US or under US law. It enabled us to obtain DIP financing, debtor in possession financing, to maintain the properties and to continue as a going concern. It also retained the optionality to explore asset disposals and or recapitalization alternatives at the same time. And it provided immediate legal protection for the aforementioned foreclosure risks. So talking a little bit more on the next slide, perhaps, about the DIP financing facility conditions. And I'm on slide 7. What perhaps people need to understand is that we ran a process to obtain the best DIP financing available. We spoke at length with 8 parties, including the bank syndicate, in order to negotiate the best terms and conditions. That at the end of the day provided us with a 12 months, $100 million super senior facility that provided EHT with the ability to continue to operate and do an orderly, let's say, process. And the process again was to find, if there was one, a recapitalization proposal or effectively a sale of the assets in an orderly fashion. And again, without the liquidity from a DIP facility, the company could simply not continue to operate. Those DIP facilities come with certain conditions, and the key conditions in this particular case were a mortgage on the 15 previously unencumbered hotels. There are certain limitations on the use of proceeds, and they can only be used on an as-needed basis and as approved by the DIP lenders under the budget, and often also supervised by the different creditor committees. And there are certain restrictions on the timeline to make sure that we would stay within the period for which the DIP was available. And in this particular case, it was conditioned that we would start a process and a sale process within 90 days and complete it within 270 days from the start of that process. So talking about maybe on the next slide, the main participants in a Chapter 11 process, which is, let's say, not too different from other insolvency processes in the world. As a cash flow insolvent entity, the REIT trustee, who is effectively the manager of the estate after the REIT manager was removed, the REIT trustee is obligated to act in the best interest of all stakeholders and not just the unit holders, as it has that responsibility. Under the Chapter 11 process, the Chapter 11 entities were supervised by the US Bankruptcy Code, and there are Unsecured Creditors Committee and Bank of America as the secured creditors who actually will need to provide consents for certain decisions and need to be sort of kept informed along the way. At all times, the trustee has really stepped up its otherwise more passive powers to oversee the process and actively manage the Chapter 11 process that the company was in. Obviously, in terms of payments, the creditors of the Chapter 11 process have priority over the creditors of the holding companies, which in turn have priority over the stapled security holders. And so that's what we call the waterfall. We think that on the next slide, please, a rigorous asset sale process and recapitalization process has been conducted. We have tried to get the best proposals on the table for either a reorganization or for a sale of the assets to maximize the value. And in a Chapter 11 process, it allows to run those two processes in parallel, and that's what we have done. Obviously, any proposal that you put forward needs to have the support from secured and unsecured creditors, as well as the US Bankruptcy Code. Whilst we had advanced with a party on a reorganization proposal during the first couple of months of 2021, we unfortunately failed to receive an actionable proposal, and that party withdrew. A stalking horse agreement was then entered into with Monarch after 2 months of solicitation and due diligence. And a stalking horse proposal effectively is you try to get the best price for the assets, and that price then can be challenged or topped in an auction process that will be conducted later on. That stalking horse process also allows you to have certainty about a deal that you can do, and it sets a target for anybody to improve on that if they can from a financial and economical perspective. Competing but qualified bids from any bidder after that stalking horse process can then be received for a period of more than 60 days, and that gives people ample time to think about it. And a lot of those parties either were already engaged in 2020 or had been engaged and approached in the first part, the stalking horse part, in 2021. At that same time, and I'm repeating myself, recapitalization or restructuring proposals can still be put forward and submitted. There was quite a bit of reporting towards the end that a process or a proposal by Constellation was put forward, partially helped by the former sponsors of Eagle Hospitality Trust, which was submitted relatively late in May 2021. However, it was deemed not actionable and failed to satisfy the bidding requirements that were put in the Chapter 11 process and were the same for every party who was looking at the assets or at a more holistic restructuring proposal. As a result, the US Bankruptcy Court deemed the petition to delay the sale as incorrect, and proceeded with the sale hearing to conduct the sale. And at the same time, that sale process was completed on the 24th of June, 2021. To hopefully, and I'm going to the next slide, to hopefully give people a sense of the robustness of the process, we have reached out to more than 300 parties in 2021 to solicit their proposals. Over 130 parties have signed an NDA, a non-disclosure agreement, and received information that was made available in the data rooms and one-on-one sessions. And at the end of the day, 4 qualified bids were received other than the Monarch stalking horse bid. You may argue that that is not a lot, but at the same time, I would like to point out that there is a stalking horse price already of $455 million. And so a lot of more opportunistic parties would not put their bid forward, because your bid is only qualified if it is in excess of that $455 million. Those 4 bids then all qualified, meaning They had certainty of funding, ability to comply with the bid deposit and other sort of regulatory requirements, the ability to meet the timeline to complete the transaction and to execute the proposed plan. On the next slide, you, in a sort of nutshell, will see the actual results from the bid process, where the stalking horse bid for Monarch was $455 million. The actual auction then created another $25 million of value. And you can see on that slide the other parties that actually decided to buy the assets and bid more than Monarch in a competitive auction process. So the combination of a stalking horse agreement and the subsequent auction, where people have ample time to look at their, let's say, best proposal, provide deal certainty and maximize the value of the properties in question, as we have demonstrated here as well. The sale process has resulted in gross sale proceeds of $481.9 million, and the sale has been completed on the 24th of June. On the next slide, you will just see some language around the process. There is, as we alluded to, a sale hearing where people can object and not object, and the United States Bankruptcy Code felt that this was a fair and reasonable process and constituted the highest and best bid. And also the Unsecured Creditors Committee, despite being significantly impaired in value, deemed the process fair and properly conducted. And I think that is an important statement, because the unsecured creditors are impaired and will not receive, let's say, their value back. On the next page, we wanted to highlight to unit holders that, you know, we did not receive any viable reorganization proposal received. We have indicated that, you know, we obviously spent the better part of 2020 finding a solution, which unfortunately did not pass at the EGM. As I mentioned, we did have discussions, in-depth discussions, with a party that withdrew. We had in-depth discussions with a party that later on morphed into the Constellation proposal and had given them guidance on, you know, what should be done in order to qualify as a proposal. And the Constellation proposal obviously did not meet the bid procedures. There was uncertainty of funding, and it was also not acceptable to the creditors as it didn't stack up against the sale process proceeds from the sale of the assets. It's important to note that Constellation asked for more time, which also comes at a higher cost, and that didn't justify let's say, the risk of losing the successful auction bids, and just had too much uncertainties around it. Where does that leave us? And obviously, this is not a happy story. On the next slide, please. So the sale proceeds are roughly $482 million, and the current illustrative claims, and those claims still need to be going through a so-called resolution process, in total are $592 million. In other words, there is a, if all the claims were resolved at that level, a shortfall of about $110 million. The proceeds hence are insufficient to satisfy all unsecured creditors in full, and hence they are impaired. It's very unlikely that all of the PropCo creditors and unsecured creditors will be repaid in full. And accordingly, and this is the bad news, the sale proceeds are not expected to result in a recovery for stapled security holders, as equity holders are last in line. So we unfortunately don't have any better news. It is the sort of result of a long and transparent process, and a process that, you know, we would have less control over in a Chapter 11, as you now have to maximize the value. And so this is the result of again, a robust process. So we've talked elaborately about the 14 properties that have been sold. And on slide 16, we want to sort of update you on the Queen Mary. For the Queen Mary Long Beach, there were unfortunately no viable prospects of a sale of interest. Subsequent substantial obligations to pay cure costs and capital improvements made it economically unfeasible, and material cash requirements are needed to maintain the Queen Mary. So it's not an economical proposition to continue with that sizable assets, unfortunately. We therefore have initiated the legal process to surrender the property, surrender the lease back to the City of Long Beach.
These remaining 3 hotels were secured to its mortgage provider. Crowne Plaza Dallas is currently marketed by CBRE and is projected to be sold by Q3 2021. Delta Woodbridge's receivers has appointed East Deal to sell the property. Hilton Houston Galleria's receiver has embarked on a mold remediation project to prepare the property for sale. However, any net proceeds from the sale of the remaining hotels after payment to the creditors of the properties will be subjected to claims from unsecured creditors and is unlikely to result in any distributions to stapled security holders. Bert, back to you.
Yeah, thank you, Jane. So to summarize, in the manager vacuum, insufficient funds and going concern issues, ongoing maintenance costs and risk of foreclosures have left EH REIT with no other option than to initiate the Chapter 11 process. And for the 15 hotels that were not mortgaged, to provide 1, immediate legal protection, access to immediate DIP financing, and retain the ability to enter the most optimal strategy. In addition to the SC proposal that was voted down at the EGM, we continue to engage with potential parties to discuss a possible reorganization or restructuring proposal for EHT, but unfortunately the 2 proposals that we discussed or received were not actionable. In particular, the proposal from Constellation, partially owned by the former EH3 sponsors Mr. Wu and Woods, was received at the 11th hour and did not satisfy multiple requirements such as deposit, certainty, financing, and actionability. The extensive sale process for the 14 hotel properties was conducted under the supervision of the US Bankruptcy Code and scrutinized by secured and unsecured creditors committees. The auction resulted in a higher sale process than the stalking horse agreement, but unfortunately did not result in sufficient proceeds to fully satisfy all the claims or leave proceeds for the unit holders. In addition, in a US Chapter 11 process, all professional fee payments will have to be approved by the US Bankruptcy Court and will be scrutinized as such. And again, I think the trustee has taken all steps to protect the interest of EHT and protect the interest of all stakeholders as it is obligated to do. This brings us to the last slide of this presentation, which really talks about next steps. And with the sale process of the 14 properties completed on the 24th of June, the creditors now have until 15 July to file their claims. And those claims will then be made part of a so-called resolution process that may take a while. Afterwards, the Chapter 11 plan, which is really the final resolution to the case, will set forth the treatment of various creditors and stakeholders of the Chapter 11 entities. The related disclosure statements will be distributed to creditors to solicit their votes to accept or reject the plan. And obviously the plan has still to be approved by the US Bankruptcy Court as well. As to the Queen Mary, as we mentioned, will likely be surrendered to the City of Long Beach. As for the remaining properties, Delta Woodbridge, Hilton Houston Galleria, and Crowne Plaza in Dallas, these are either being marketed or prepared to be marketed. However, the sale proceeds, even if the sale proceeds would exceed the mortgage balance, will likely not lead to a distribution to the stapled security holders. And also, please note that for 2 of those properties, a receiver has been appointed who will be in control of that process. Then last but not least, and this is sort of a good thing about Chapter 11, there is an ongoing investigation about and a discovery process in relation to the application of the, amongst others, unauthorized PPP loans, the unpaid rent in the beginning of 2020, and the unpaid deposit from the sponsors under the master leases. And so further information will be provided if and when available and relevant, but it allows us at least to get full clarity on, let's say, the backdrop of those issues that we have flagged in multiple announcements. So it brings us to the end of the presentation. Unfortunately, not a lot of good news to the unit holders, and I will hand over back to Mervyn for the Q&A.
Thank you, Bert and Jane, for the presentation. Let us now proceed to the question and answer session, and I will invite Danny from Rajah Tann to be on the panel as well. I will start off this session with the first question. At the EGM in 2020, stapled security holders voted against the winding up and delisting of EHT. Why have you gone ahead to do the exact thing that stapled security holders voted against? May I invite the panel to address this question, please?
Thank you, Mervyn. In the circular issued in connection with the EGM on 30th December 2020, it was stated that if any of the requisite resolutions relating to the appointment of SC Capital was not passed and or carried at the EGM, we would likely be compelled to seek insolvency protection under Chapter 11 of the United States Bankruptcy Code. In the weeks leading up to the EGM, our professionals and ourselves had actively engaged with stapled security holders and held several discussions with large stapled security holders to share the merits of the proposed rehabilitation plan put forward by SC Capital. Unfortunately, even though the majority number of the voting stapled security holders voted for the resolutions relating to the rehabilitation plan at the EGM, it carried insufficient votes to pass all of the necessary resolutions. As there were no viable alternative options, and with the resolutions relating to the most credible proposal for EHT having been voted down during the EGM, certain subsidiaries of EHT filed for Chapter 11 protection after consultation with its professional advisors. Given the circumstances, the Chapter 11 filing was considered to be in the best interest of EHT and its stakeholders, as it would give the relevant entities and the assets protection against the risk of foreclosure from the creditors, and allow the Chapter 11 entities to obtain deep financing to pay for critical expenses, and to give EHT the runway to execute any potential value-maximizing strategies or propositions. As shared earlier by Moelis, as part of the Chapter 11 process, a rigorous sale process was conducted to obtain the highest or otherwise best bids for the Chapter 11 properties. We have at all times remained open to collaborating with all qualified parties to identify and explore all available options for EHT and its stakeholders.
Thank you, Jane. EHT filed for Chapter 11 early this year, which is a process Singapore-based staple security holders are less familiar with. What are the constraints and challenges involved in the filing of Chapter 11? Since EHT is listed in Singapore, why did the acting parties not file for bankruptcy in Singapore instead? And I would perhaps address this question to Danny from Rajah Tann. Danny, please.
Thank you, if I may. It is true that EHT is a staple trust that's listed on the SGX, comprising of the REIT and the business trust, and that is established in Singapore. However, it's important to bear in mind that the REIT's corporate structure, in essence, comprised mainly of US incorporated entities, and the entire asset portfolio underlying the trust was and continues to be located in the US. Given those circumstances, the natural choice was for the REIT to file for Chapter 11 instead of proceedings under Singapore's insolvency regime. Indeed, the REIT's financing and most of its contractual obligations were governed by US law, and its major creditors were based in the US. As alluded to by Bert from Moelis earlier, The Chapter 11 process also provided a global automatic stay, particularly relevant as against the US creditors upon the forbearance with certain of them ceasing earlier this year. Thank you.
Thank you, Danny. Why did you go into Chapter 11 instead of waiting out for a recapitalization or reorganization plan? Why wasn't a rights issue considered for proposal to shareholders, since there is cash flow needed for a period to recovery of the hospitality industry? Why are you in such a hurry to sell off the assets? You should have waited out longer. Once again, may I ask the panel to address this question?
Yeah, Mervyn, perhaps I'll take a stab at that. There's a bunch of questions in that question. I'll try to sort of unpack it as good as I can. During the course of 2020, DBS Trustee, and again, I'm talking about last year, together with the team, had taken steps in exploring all options available to EHT. This included conducting a strategic review and carrying out an RFP process. The first attempt at that RFP process unfortunately could not proceed, as the owners of the sponsor took the position that they had legally committed to an exclusive arrangement with a third party. At the end of the day, that third party investor decided not to proceed with the transaction, which has cost us, of course, valuable time. Subsequently, DBS trustees instructed Moelis to commence an exhaustive RFP process to seek proposals for EHT on an expedited basis from interested parties. To put that in perspective, we needed new capital and we wanted to replace the manager. Those were the two main objectives. After a full RFP process, only a few comprehensive proposals were received, and SC Capital was selected as the party that had put forward the most credible proposal for a replacement manager of the REIT. This plan was the only proposal acceptable to the lenders of EHT and thus capable of being implemented. However, the necessary resolutions, as we all know too well, were not carried. So after the EGM, the trustee, together with the assistance of Moelis, continued to explore the restructuring and recapitalization alternatives and invited proposals for these, including engaging in discussions with several potential interested parties in relation to the restructuring and recapitalization of the REIT. However, as we said in the presentation, none of those discussions actually led to a proposal. And without new capital, after we had that position on the EGM, there was simply no prospect for EHT to simply wait or continue, as you just need oxygen for the company, you need liquidity for the company to continue operating. And the only way to do that and to stave off foreclosure by the banks was to seek protection under Chapter 11 and to tap into DIP financing. Otherwise, we could simply not continue to operate these properties and operate the company. So the question in isolation, why did you not wait, is unfortunately just not possible. We had alluded to that in the circular as well. But the fact of the matter is you simply need money to operate the business. And if there's no money left, you have to do something else. And that's why we went through the pain of trying to avoid that. And once we had to file for Chapter 11, the first priority was to tap into liquidity in order to be able to continue to operate. The sale of then certain properties in EHT portfolio in the Chapter 11 process was not a rush job by any means. It was a coordinated sale conducted by a sort of us in a widespread marketing approach to sort of 300 parties, as we alluded to earlier. During this process, we discussed all these parties' interests, signed the NDAs, as we said, and conducted discussions with sort of serious parties. And at the end of the day, that led to a stalking horse agreement. The qualified parties that we had in the process included real estate focused asset managers, global multi-strategy asset managers, publicly traded REITs, high net worth investors, sovereign wealth funds, private equity investors located primarily in the US and Asia. And again, all the parties that we had in the RFP process were again invited to participate in this process so that we would not overlook any party. So at the end of the day, 4.5 bids were received, and that led to an improvement of the stalking horse bid. And as such, with the supervision and approval of the US Bankruptcy Court, the 4 properties were sold. The possibility of a rights issue was considered to recapitalize EHT. Again, the proposal that we had to the EGM was new capital coming in from the banks at very reasonable conditions and hardly any dilution to the unit holders. And so in that process, we also considered a rights issue, but one, of course, a rights issue will take time. 2, it takes also support from the unit holders, and we had sounded out unit holders and received a lukewarm response to that. And 3, it would have been very dilutive at the same time. So we did believe and do believe that the SE Capital proposal was far superior to, let's say, a rights issue. And we were far from convinced that a rights issue would allow us to raise the amount of capital that we would need to continue to operate the business.
Thank you, Bert. If I may move to the next question. Why did the DBS trustee object to the EHT ISC to represent stapled security holders in the Chapter 11 cases? For this, I would ask Jane to please address this question.
Thank you, Mervyn. The trustee had little choice in the circumstances. It was advised that the proposed appointment of the ISC as an official committee of equity holders was highly likely to be rejected by the United States Bankruptcy Code as not being beneficial, and supporting this would in fact prejudice the EHT group's position and ultimately the unit holders in the Chapter 11 cases. This is because, firstly, appointment of an official committee of equity holders is an extraordinary relief in Chapter 11 cases and is rare. In this case, the trustee was advised that the high threshold for the formation of such a committee was not met. Secondly, the official committee of unsecured creditors opposed the proposed appointment of the formation of the equity committee in circumstances where their support would have been critical. Thirdly, the appointment of an official committee of equity holders would have served to increase costs rather than improving the position of stapled security holders, as the fees of professionals retained by such committee would have to be paid for by EHT.
Thank you, Jane. Allow me to move on to the next question. In April 2020, there was still around $89 million in cash, but by the time of the EGM, there is nearly none. Could you provide further explanation on how the cash was utilized? Bert, would you like to jump in on this?
Yeah, thank you, Mervyn. So first, I think it's important to understand that out of the $89 million, not everything was unrestricted. There were, let's say, security deposits, etc. So that's a first point I would like to make. Then between April 2020 and December 2020, the trust had expenses that were incurred to assist EHT to manage a myriad of issues relating to the properties due in many instances due to the delinquencies of the master lessees. First, there were various payments under the master lease agreements which were not paid by the master lessee, such as real estate taxes, transient occupancy taxes, as well as penalties and interest. 2, premiums for mandatory insurance, capital expenditure requirements due to the poor maintenance and care of the hotels, and 4, the need to defend against litigation brought against EHT in the US for various defaults and actions of the master lessees. So it was sort of quite an intense period. Second, it was imperative to fund necessary and critical expenses for EHT and its underlying portfolio to protect and safeguard the asset value of EHT's portfolio. In order to, and again, these were unprecedented times with COVID and most of the hotels closed, in order to avoid abandonment of the hotels, EHT had to implement caretaker arrangements with relevant hotel operators and fund certain expenses related to franchisors, unpaid fees and expenses, unfortunately dating back to as early as 2019. So I'm afraid we inherited some legacy issues. Third, EHT also had to defend various judgments and or mechanical liens filed against EHT's properties in the US and work with legal counsels to obtain forbearance from EHT's lenders to prevent foreclosure of the hotels. There were other expenses incurred in connection with the review and assessment of all the restructuring proposals submitted by interested parties during the RFP process, the preparation and convening of the EGM meeting, and securing of the DIP financing when the resolutions at the EGM were not passed. So quite a myriad of things. And the limited resources of EHT were utilized on a as needed basis only. There was a proper process implementing, including the review by the trustee after obtaining the recommendation by the then existing manager of EHT and professionals advisors, as well as obtaining the approvals from certain of EHT's lenders. So I guess what we're trying to say is we didn't just spend money left, right, and center. It was critically reviewed by the trustee. It was critically reviewed by the bank group and only on a sort of as needed basis. But there were a lot of needs at that point in time.
Thank you, Bert. So the next question then asks itself as follows: how are minority investors going to be compensated? Would any one of the panel members like to address this?
Yes, I unfortunately have the the task to address that question, and we addressed it in the presentation as well. And the hard reality is that the market value of these properties proved to be lower than what the creditors have outstanding. I think the marketing process and the absence of restructuring proposals have unfortunately made it necessary to sell the assets given where we are in a Chapter 11 process after we didn't have a resolution approved in 2020. And so the hard reality is that there is not going to be sale proceeds for the recovery of stapled security holders given the value realization of the process to date.
Thank you. Next question. What responsibility does DBS trustee have to stapled security holders? May I ask either Danny or Jean to address this question?
Thank you. I'll take that. I think it's important to take a step back and understand the structure. I mean, first and foremost, DBS trustee acts as trustee of the REIT, and in that capacity holds the assets for the trust for the benefit of the security holders. Its role really is to be the custodian and to safeguard the rights and interests of the security holders and exercise its powers as a trustee and its ownership powers in relation to the properties of the REIT. Now, that is quite different from the day-to-day management of the REIT, which fell on the REIT manager and not the trustee. Nevertheless, you will recall that given the challenging circumstances that the REIT faced in 2020, in the interest of the security holders, the trustee had stepped up to support the special committee that was formed, comprised of members of the board of directors of the then REIT manager. The trustee, together with the special committee, oversaw the daily operations and decision-making process for the REIT. If you would also recall, that special committee was formed with a key focus on safeguarding value for and protecting the interests of the stapled security holders, and comprised the then CEO as well as the independent directors of the REIT manager. Now, what had happened then was that the trustee, together with the special committee, had mandated Moelis as the financial advisors to the REIT to conduct a strategic review and carry out an RFP process. However, as alluded to by Bert earlier, that process was not able to proceed, and a contemplated transaction for the acquisition of a controlling stake in the REIT manager fell through. That was then followed by a process where Moelis undertook an exhaustive further RFP process to seek proposals for EHT on an expedited basis that ran throughout the second half of 2020. That eventually led to the SC Capital proposal being secured and tabled at the EGM, which was unfortunately unsuccessful. Post the AGM, the then REIT manager was removed by the trustee pursuant to the direction of the MAS, That created then an unprecedented situation in which the trustee was required to step in to help steer the REIT with the assistance of professional advisors in the absence of a manager, a situation that was truly not contemplated in the structure. During that entire process, the trustee had gone over and above its responsibilities as a trustee of the REIT and has at all times sought to protect the interests of all stakeholders of the REIT, including the stapled security holders. Back to you, Mervyn.
Thank you, Danny. Are you not also a creditor to EHT? Therefore, is your role as REIT trustee a conflict of interest and not beneficial to minority shareholders? I will put this question to Jane, please.
Sure. Aside from any accrued but unpaid trustee fees, DBST is not a creditor of EHT. DBST, as trustee, has consistently exercised its duties with due care and diligence and without conflict, and we continue to do so. DBS Bank is a lender in the US $341 million syndicated loan granted to the REIT, but that does not concern DBST. DBST is a separate legal entity, and we act independently from the bank. There are established Chinese walls and conflicts risk management policies and standards that apply to all DBS group entities so as to manage any potential conflicts and flow of information. The policies and standards require DBS entities to act separately and maintain confidentiality of the information within their units.
Thank you, Jane. The next question. What level of due diligence, in particular market reputation and financial resources, was done by DBS and SGX on the sponsor at the time of the IPO? Even prior to COVID-19 effect on the US hospitality market, it would appear that the sponsor has insufficient financial resources to support the master lease rental payments, which is the key supporting point for the assets valuations injected into the REIT at IPO. Many feel that insufficient due diligence was conducted. Could the situation have been avoided? May I invite Danny to address this?
Thank you. I think where we stand now today, it is clear that the post-IPO issues facing the REIT is a result of, amongst other things, multiple delinquencies on the part of the previous master lessees with regard to its obligations under the master lease agreements for all the 18 properties. As Bert had pointed out earlier, the REIT had to expend significant resources in order to pay off legacy liabilities that were in fact the responsibility of the master lessees. Now, whether these delinquencies could have been avoided by pre-IPO processes is certainly not something that the trustee is in a position to speculate on. The trustee, as trustee of the REIT, was in fact not directly involved in the due diligence process for the IPO. Having said that, what the trustee does know is that the listing application process was assessed by the regulators, the sponsors, the underwriters, and respective legal advisors at or around the time of the IPO, and the potential risk factors, as always, involved were disclosed in the IPO prospectus. The trustee also understands that the listing application process and due diligence were guided and supported with the advice provided by an experienced team of external professional parties, including reporting accountants, independent valuers, independent market research consultants, and legal advisors.
The security holders invested in this stock because they believed in DBS as the financial advisor. They believed that even when the problems arose, they expected DBS trustee to do the right thing and act in the interests of security holders. Jane, would you like to comment on this question?
Thank you, Mervyn. We would like to assure all staple security holders that DBST as trustee of EHT has at all times carried out our fiduciary duty to the best of our ability and sought to protect the interests of all stakeholders of EHT, including EHT staple security holders.
Thank you, Jane. And I have a final question for the panel. And the question goes as follows. Are there plans to delist EHT REIT following conclusion of the asset sale? If so, why aren't other proposals considered to retain the listing status so that there is a chance of recovery for the stapled security holder? May I invite the panel to address this?
Thank you, Mervyn. Let me just take this one. Now, following the conclusion of the sale and of foreclosure of all of EHT's properties and eventual distribution of the sale proceeds to EHT's creditors in accordance with the Chapter 11 Plan and Procedures, the REIT will no longer have any material assets remaining. As the REIT still does not have a manager in place and no viable proposals has been received by the REIT to date, the trustee and our professional advisors will most likely need to engage the regulators, including the SGX, to facilitate the proposed delisting and winding up of the REIT from the official list of SGX.
Thank you, Jane, for addressing that last question. And with that, we come to the end of the SIAS EHT dialogue session. At SIAS, we hope that the best efforts and alternative plans will be explored to protect the value of stapled security holders. Thank you, panelists, for taking the time to address the questions. Take care and goodbye.